All right, I've got 10:45 on my clock, so we'll get back started again. So our next presenter is going to talk about new varieties, new pulse varieties for Saskatchewan growers. And our presenter is Laurie Friesen, who is the seed program manager at Saskatchewan Pulse Growers. Laurie has a Master's of Science degree in agriculture and came to Pulse after a career with canola research, and specifically in areas of breeding and trait development, biotechnology, and genetic improvement. And Laurie started with Saskatchewan Pulse Growers in 2014, and then switched roles a little bit in 2016 to become the seed program manager, and looks after variety commercialization, as well as coordinating our regional variety trials for soybean and pulse crops. So Laurie, if you would like to start, thanks.
Thank you, Corey. I appreciate that. So good morning, everyone. Today I am excited to talk to you about the new pulse varieties available in 2022. And I'm going to start out with lentils. So first of all, I want to show you a little bit about the trends in large green lentil varieties. Now, Jasmine, for some reason, my picture is blocking my entire view. Is there some way to get rid of that?
Is it your go-to webinar control panel that's blocking?
It's my face.
There may be a way to click and drag the corners, or if that's a separate window, just move it out of the way. But we can see your presentation.
Okay, good. As long as that's not just my face. Okay, so going back to the trends and varieties, you can see that CDC Green Star continues to dominate acres of large green lentils, and up until 2020 it was gaining an increasing percentage of large green acres despite the lack of IMI tolerance. The main reason for this is its consistently high yield. However, some of these acres are starting to be replaced with the Clearfield variety CDC Lima, which was released in 2018. Concurrently, the older varieties CDC Improve and CDC Empower are also declining in favor of higher yielding varieties. So the graphs on this slide show the relative yield of large green lentil varieties, both as a bar graph and as a relative ranking obtained from statistical analysis of up to 10 years of regional variety trial data. As you can see, CDC Green Star ranked first overall. CDC Empower and CDC Improve, which still occupy 12% and 5% of large green acres respectively, ranked at the bottom. CDC Lima is a Clearfield variety that is showing considerable promise, ranking second just behind CDC Green Star. If we look at ranking by location, we can see that CDC Green Star ranked first at 8 out of 10 sites, and this is from multiple years of data. The Clearfield varieties CDC Lima and CDC Grim are emerging, and with more years of data may rival CDC Green Star, and with the added benefit of a slightly larger seed and herbicide tolerance. So talk a little bit more about CDC Lima. So again, it's a high-yielding large green Clearfield lentil variety. In 9 years of testing in the co-op and regional variety trials, it yielded 11% higher than the Clearfield large green lentil CDC Empower in the brown and dark brown soil zones, and 20% higher in the black and dark gray soil zones. Compared to the conventional large green lentil CDC Green Star, it did yield 6% lower in the brown and dark brown soil zones. However, it yielded 6% higher in the black and dark gray soil zones. So there is an added benefit there to this variety. It also has a large seed, and that is actually slightly larger than CDC Green Star. Now looking at trends in small red lentils. Although CDC Maxim continues to dominate the small red lentil acres, it is declining year over year in favor of higher yielding varieties such as CDC Proclaim and CDC Impulse. CDC Red Moon is also increasing slightly. However, uptake has been very slow due to the lack of herbicide tolerance. There does seem to be some renewed interest in this variety, however, due to its high yield and the emergence of other herbicide options to control weeds. Again, looking at a yield comparison, here again, this data was obtained from up to 10 years of regional variety trial data, and the chart on the right shows the relative ranking. And here we can see that CDC Red Moon did rank at the top overall. However, it can be misleading as the top 8 ranked varieties are not significantly different for the most part. However, the top ranked varieties do have significant yield benefits over the older varieties that are ranked near the bottom, such as Maxim, Dazzle, and IMAX. So there definitely are some varieties that are yielding quite a bit higher than the old sort of standby varieties. CDC Red Moon yields 114% of CDC Maxim in the brown and dark brown soil zones, and 104% in the black and dark gray soil zones. With 61 site years of data, it ranked in the top spot overall and maintained this position 4 out of 9 locations, those including Rostern, Hodgeville, Scott, and Swift Current. It also ranked high at Limerick, Elrose, and Saskatoon. So it's broadly adapted to a large range of environmental conditions. As you can see, as typically the case, the non-Clearfield varieties had the overall higher yield versus Clearfield varieties, with the exception of CDC Scarlet, which is a non-Clearfield variety that didn't rank very high. So just to introduce a couple of fairly new species or varieties here. CDC Simi is a new small red lentil that'll have some certified seed available for the first time in 2022, but with a much greater availability of seed anticipated for 2023. In 6 years of testing in the co-op and regional trials in Saskatchewan, it yielded 109% of CDC Maxim in the brown and dark brown soil zones, and that made it the highest yielding small red Clearfield lentil in the soil zone. It also yielded well in the black and dark gray soil zones at 103% of Maxim. All other agronomic characteristics are similar to Maxim. The other small red variety that's new is CDC Nimble. It again will have very limited certified seed available for the first time in 2022, with much more anticipated for 23. In 6 years of testing in the RVTs, it yielded 108% of CDC Maxim in the brown and dark brown soil zones. And in the black and dark gray soil zones, it yielded 107%, and that makes it the highest yielding small red lentil in this soil zone. All other characteristics are similar to CDC Maxim. So the consistent high yield over all soil zones is indicative of good yield stability in a wide range of environmental conditions, which can be a very important factor for a variety. In terms of certified seed availability, now this is the second year for CDC Lima, although the first year there was only very limited quantities. So this is sort of the first big year for this variety. And there are currently 15 seed growers advertising certified seed for sale. So availability should be good, pending seed production during the 2021 drought. Both CDC Simi and CDC Nimble are very new with very limited seed supply, but we can anticipate quite a few more growers will be, or seed growers will be advertising seed in 2023. So we'll now move on to peas. Now looking again at trends in yellow peas. Although CDC Meadow continues to dominate the yellow pea acres, it has declined quite dramatically year over year as it is being replaced by higher yielding varieties such as Inca and CDC Spectrum. Originally, CDC Amarillo gained a lot of favor early on, but it's been declining steadily, which may be due to seed coat breakage issues, as well as having some higher yielding options available. In terms of yield ranking, Again, this is a relative ranking from up to 10 years of regional variety trial data. And older varieties such as CDC Meadow, Golden, and Cutlass rank at the bottom, with the more recent varieties such as AAC Chrome, CDC Inca, CDC Amarillo, CDC Lowachko, and Spectrum ranking fairly equally at the top. Now, the top 5 or 6 ranking varieties are likely not statistically different from each other, but they would be statistically better than the lower ranking varieties. So just to talk about a few of these individual varieties. This one is a variety out of Agriculture and Agri-Food Canada, and it's marketed by FP Genetics. AAC Chrome was first available to growers in 2021. In 7 years of testing in the Saskatchewan RVTs, it yielded 106% compared to the Czech CDC Amarillo in the south and 104% in the north. It also ranked at the top in statistical analysis of long-term data, which included 44 site years for this variety. Ranking by site showed that it ranked at the top at Indian Head, Kamsack, Saskatoon, and Swift Current, which again shows adaptation to a broad range of geographies. It does have lower protein, however, which is 1% lower than the protein Czech CDC Amarillo. Another new variety is CDC Lowachko. This was developed by the Crop Development Center. This variety has good yield in both the north and south geographies, yielding 102 and 103% respectively of the Czech. It's showing promising performance, and statistical analysis of the 5 years of testing in the RVTs has it ranked in the top 4 varieties. CDC Lowachko has the highest protein of the LP varieties at plus 0.9% of the Czech. This will help ensure that it is sought after by pea processing companies. It also has very good lodging resistance. It also has very good seed characteristics and is rated good for resistance to seed coat breakage, resistance to dimpling, has less green coloration, better than Inca or Spectrum, and it has a good round shape. Another new variety is will be available to growers for the first time in 2022 is AAC Profit, again developed by AFC and marketed by FP Genetics. This variety is showing particularly high yield in the north, where it yielded 110% of the Czech. It also has high protein at 0.8% higher than CDC Amarillo, and is rated good for seed coat breakage, and has a medium seed size. So this is another one to look out for this spring. Although my topic for today's talk was to focus only on varieties with certified seed available this spring, I couldn't help but give you a sneak peek of what's on the horizon. As you can see, there's 4 really strong varieties that are in the seed multiplication stage, having yields of anywhere from 108 to 110% of the Czech. And 2 of these coming out of the Crop Development Center and 2 out of AFC. So these ones will be worth looking out for in the future. In terms of certified seed, there should be a good supply of certified seed available of the 3 varieties that I highlighted, with anywhere from 12 to 18 seed growers advertising certified seed. So the only thing is that it'll be pending the amount of seed they were able to produce in 2021 because of the drought. So hopefully there's a lot of seed out there. Okay, I'm going to move on to fava beans. Snowbird continues to be the most widely grown fava bean variety in Saskatchewan, occupying about 70% of fava bean acres. A very small proportion of acres are seeded to the colored flower variety FB9-4, only 5% of those. So there are many factors to consider when selecting fava bean varieties. First, you want to decide whether you want to grow colored flower tannin types, which are typically exported for food, or versus the white flowered low tannin types that are generally grown for feed. You have to consider seed size, what size can your equipment handle, and what is economical for seeding. Seed sizes range anywhere from 325 grams per 1,000 seeds all the way up to 695, which is a really wide range. You need to consider the market demand for the above, and finally, yield and overall performance of the variety. So for the white flowered low tannin types, there's not an abundance of options. However, more varieties are in the early stages of seed production and will be available in the future. For 2022, there are 14 seed growers advertising certified seed of the mainstay variety Snowbird. Another option that's new is CDC 219-16. This is the first year that certified seed is available. However, there's only one seed grower that has seed already at the certified seed stage, so it's going to be very limited. There will be much more certified seed available in 2023. This variety is a good option. It yields 2% higher than Snowbird and has a smaller seed, which makes it easier and more economical for seeding. It does mature 2 days later, however, than Snowbird. For the colored flower tannin types, Fabel is a new variety developed by DL Seeds and is available through SeedNet. This is the first year of certified seed sales for this variety. It yields 13% higher than the long-standing variety FB9, and it has the best standability for this type. Maturity is 1 day later than Snowbird, and it is considerably later than the early maturing variety FB9. It does have a smaller seed than FB9, making it easier to seed and more economical. This is also a low vicine convicine variety. Now, you've heard me talk a little bit about this before, so I won't go into a lot of detail, but it does present a really good opportunity to use faba beans in fractionation through the removal of the anti-nutritional vicine and convicine components. So the industry will be switching over to low vicine convicine varieties. So this is something to look forward to. The only problem is that the trait, it can be contaminated through cross-pollination with other varieties. So this is something to be very aware of, and isolation distances of up to 2 kilometers may be necessary to maintain the low vicine convicine trait. So if you are looking for more information on varieties, you can check out our website. We have variety tech sheets on our website. These are available for download. And also we post yield performance data, and we will be expanding the utility of performance data in the near future. So keep a lookout for announcements on that, which will make it a lot easier to search for comparisons of varieties and how they perform in different regions of the province. For sourcing seed, to find certified seed, make sure to check out CSGA's online seed directory, also the SAS Seed Guide, and also Saskatchewan Seed Growers Association has their new interactive seed guide online, which will help you to not only search for seed, but also look at comparative data for those varieties. And stay tuned for future announcements for a variety showcase being planned for this summer, held at several locations in the province. These will be run by seed growers, and tours will be offered by SPG. So this year we'll be focusing on peas and lentils, and we'll showcase new varieties versus the old standbys. Select seed growers will run these trials, and this will be a good way to tap into expertise as they're the first to grow the new varieties on a field scale, and they have experience with multiple varieties for talking about comparisons between varieties. So this will be something to keep an eye out for, and we'll be providing more information. And that brings me to the end of my talk. So thank you so much for having me as part of your day.
Thanks, Laurie. And again, any questions for Laurie around varieties or what we're doing with demonstrating the varieties with that new program, fire your question in the question box. So a bit of a different direction now with presentations. Our next presenter is Greg Northey, who is the Vice President of Corporate Affairs at Pulse Canada. And I don't have much written down for a bio for Greg, but I don't know, Greg's been at Pulse Canada for probably 7-8 years, I'm guessing, something like that. And I know you'd worked with CFA prior to that. So Greg's going to talk primarily, you deal with market access and crop protection and transportation would be the sort of the primary areas under Greg's portfolio. And today going to talk primarily around transportation and some of the container supply chain issues that have been very prevalent this past 6 months in particular and something like that. So Greg, if you want to start off with that.
Thanks, Corey. And can you see my screen just to check?
Yep, we can. Sure, looks
perfect.
Good.
Yeah. So so exactly. So Greg Northey, thanks very much for having me. It's a real pleasure to be here to talk to you about this issue. And many of you have maybe heard about it or seen news about it. And I'm just going to try and unpack a little bit of what's been happening with the containerized supply chain, because it has been an issue we've been dealing with for a little while. And there's been a lot of news about it. So I'll try and give a sense of what's going on. So first of all, why is this important? And so this will be familiar for many of you, but containers are very important for the pulse sector. You can see here trend lines of the percentage of pulses exported in container through Vancouver particularly. And you can see that, in 2018, it went above 80% of lentils were in container. Right now, 2021, our latest data, year-to-date June, was just over 40%. Peas have been starting to climb as well in container. And so, overall, our rule of thumb in general, once you include Montreal and Vancouver, is that every year about 45% or in and around there of our exports are in container. And so it's an extremely important supply chain for the sector. We have, entire industries built to provide service to it. So I'm thinking here of, say, transloaders in Vancouver and Montreal, who are, their primary business is just moving pulses from either domestic containers into ocean containers or from hopper cars into ocean containers. So it's just very important. And this is why we spend, as you'll see, quite a bit of time in trying to address some of these disruptions we've seen. So what has been happening, and it's been a bit of a long period, and it all sort of began, or at least the most acute problems we're seeing began with the early pandemic lockdowns, and even a bit before that, once when COVID first hit China and factories were shutting down. But the lockdowns plus the factory shutdowns, world trade dropped, incredibly. It was unprecedented drop. And what we saw was shipping lines. So the owners of the vessels that move containers, started to cancel a lot of sailings. We saw a lot of blank sailings. Unfortunately, at that time, there was a huge demand for pulses and food generally. Even though all the economies were shut down, there was this a surge in desire for pulses. So at that point, we were initially impacted by just blank sailings. Just there was not any ships moving and around. And then once we saw the lockdowns end and we saw a surge in consumer spending, it was kind of the whiplash effect, where that imbalance that we saw with containers around the world, it hit a lot. And China and Asia there's this explosion in demand of goods from those areas, and they needed to have containers there extremely quickly to fill up with consumer goods, TVs, etc., to come back to North America and Europe. And so there was this huge demand to get containers back to China very quickly. And it was around that time where container prices would have gone for people wanting to ship, TVs from China to North America. Usually they would have paid, around $10,000 a container, and around there, it went to almost $30,000 per container. And so, you know, there was just this incredible demand. And at that point, in that fall, the pulse sector was just really unable to access empty containers. They just weren't available for use. And that trend has continued, but with some new wrinkles now in 2021, and as we move into 2022, is that the shipping lines, the owners of the shipping lines, they realize that by adjusting their capacity allocation, by adjusting how they function, demand matching supply with demand a little bit more, and realizing where the money was, where they were making their biggest profits, they really started to systematically change their business models, deprioritizing exports, raising costs and for them, changing routes, withholding service, and I'll get into a little bit more detail on that. And to the point now where containers are around, but they're at really incredible prices. And even if you're willing to pay it, you get your product loaded in a container, you won't necessarily get on a ship because they're just deprioritized. So they'll just sit around for months and months on end, waiting to get on a ship. You'll get rolled and rolled and rolled. And so it's a bit of the perfect storm where everything we saw before, whether it's vessel availability or container availability, it's now sort of a systematic problem that we have where there's just not the service for export containers. So how can they do this? And this is a really important point with this market. I mean, we face, you know, interesting monopolies in Canada regarding the rail system. Well, we face something very similar when it comes to these shipping lines, these container lines. So they form themselves in alliances. So, you know, 5 or 6 of the major shipping lines will group themselves in alliance where they basically, it's like a code share almost, like you would see in airlines, but they work together on routes, on service, on demand, on capacity. And what we have is that the 3 major alliances represent between 86 and 98% of market share on the main east-west, basically liner trade, so essentially the routes. So effectively, we're dealing with an oligopoly. It's a highly concentrated market, and what they've basically realized is that they have so much control over this that they're really maximizing their profits. And I think you may have seen news on the kind of profits that they are making, but you know, Maersk and these others have never seen the profits that they've seen that they're seeing right now, like in the billions. They've in this year alone, Maersk has made more profits than they made in the previous 10 years. So it's just really incredible the success that these shipping lines have had, and it's really shown up in how they've started to manage their markets. So what are we seeing then? What does it mean? So the fundamental piece that we're seeing right now is that we're just not seeing the same routes available to some of our major markets. So they've just pulled actual vessels from servicing those markets. So to get to the Indian subcontinent or South America, the routes that we would have had for many years as far as getting there, they just don't exist anymore. So you can imagine that just takes more effort to get your container to some other place like China or others, try and get on a feeder line. You're having to use multiple routes to get there. And the real reason is they just don't want to send containers there. It's just not as profitable for them. As a result, your bookings just are not available. As I said, if you get your products in the container, you can see up to 6 months waiting just at port in Vancouver or at the transloader just to get on a vessel. The way it works is generally you're usually you get on it. Now they'll just keep rolling you. You don't get your container on a vessel, and it just adds cost to retention. It just adds everything. Otherwise, you know, within the supply chain, vessel delays, equipment shortages, we're seeing it all right now. And you can see here costs. I'll just give a sense of where it's cost. We're seeing the bulk index drop at the moment, but the container costs peaked earlier this fall, and now they're starting to rise again. For an export container, well, in 2020, we would have seen around $1,300 to $1,800 a container. Now it's around $3,500 to $4,500, and that's climbing again in early 2022. So it's a significant cost for these containers of pulse crops.
Just a heads up, Greg, we've got about a minute left here.
Perfect. And so the issue for us at the moment is will this change on its own? And the worry right now is that it won't, because the shipping lines have essentially found a very profitable model for themselves. From Pulse Canada's perspective, we've done two things. We've built a coalition of other organizations that are faced with this outside of agriculture and within agriculture. We're calling it the campaign, a container crunch. We've been raising this issue since 2020. Government has been not particularly receptive to this problem. It's in stark contrast to the USA, where they've introduced a new bill. They're going to be forcing, capacity for export containers. In Canada, it seems to be a non-issue for the government, so we've been raising awareness around it. Over the long term, it's really around what our legislative structure should look like for shipping lines. Like I said, the US, Europe, Australia, New Zealand, they're all looking at this because they're realizing that there needs to be a new structure to bring accountability to shipping lines. So we've developed a long-term strategy we've done, and we're at this point, we're completing an impact assessment. And ultimately, there's opportunities for us to look at to bring in complaints to the Canada Transportation Agency or the Competition Bureau around what's been happening. So just in summary, it's a real problem, not just for our exports, but it's driving up costs of consumer goods, driving up the cost of inputs for farmers and others. We have real concerns around the long-term health of this supply chain. And whether it will be there when we have another bumper crop. So the fall is looming large for us, and we're not sure whether they will have the supply chain in place. And ultimately, our long-term focus is on trying to bring that accountability to the shipping lines. So I'll leave it there, Corey. So welcome questions during the question period or in the chat. Thanks.
Yeah, thanks, Greg. Fairly quick look at a complex issue, but clearly one that we've got to keep working on. Lots of concern raised there. So thanks, Greg. Our next presenter is also from Pulse Canada. We're going to hear about the National Pulse Market Strategy. Since 2016, Pulse Canada has had the strategy to diversify 25% of our production into new markets by the year 2025. And Dr. Julianne Curran is the Vice President of Market Innovation at Pulse Canada, and joining us today to share more about this strategy and sort of where we're at in terms of reaching for this goal. Dr. Curran has a PhD in Human Nutritional Sciences and has worked at Pulse Canada for quite a while, since 2005. So in a current role as Vice President of Market Innovation, Julianne leads and develops the development and implementation of marketing strategies to diversify markets of Canadian pulse crops. She works closely with a broad range of stakeholders, including grower associations like ours, and food pulse processing industry, scientists and government, health professionals, and to identify strategic priorities and research in these areas and work towards some of these market goals. So welcome, Julianne.
Thanks, Corey. Just want to do a check. Can you see my presentation up here in presentation mode?
Yes, I can hear you well.
Great. Okay. Well, I'll get right to it. Just first of all, thanks to Saskatchewan Pulse Growers for the opportunity to present to you today an overview of our national milk market development strategy and progress that we've been making. I've got a kind of a very brief amount of time to share with you some highlights from a lot of different work. So I'm going to move through things pretty quickly. Wanted to first provide you with a little background and context on this 25 by 2025 target. It was set by the Pulse Canada board as a market diversification goal that would achieve meaningful outcomes from a Canadian producer and processor and exporter perspective. And this goal was to see 25% of Canadian pulse production, or roughly 2 million tons, going into non-traditional markets or value-added processing by the year 2025. Through a lot of extensive benchmarking studies, modeling exercises, stakeholder consultations, we used all that data and information and broke that target down into meaningful volumes for diversification for the crops we're producing here in Canada, as well as producing this strategy framework that you're seeing on the screen that really guides our work to ensure that we're focused on the right audiences, the right processing streams and regions that are aligned with the biggest opportunities for volume and value for each particular crop. With chickpeas, the forecasted growth for chickpea consumption in the US was actually aligned with what our diversification target was. So to date, we haven't had a dedicated market diversification focus on chickpea. And with the time I have today, I'm not going to be able to go into a lot of detail for all of the strategies. So I've prioritized talking about peas, lentils, and faba beans, given their more relevant production here in the province. The diversification strategy for peas is focused primarily on the North American market to leverage that growing pea fractionation capacity I'm sure many of you have heard about, as well as volume opportunities for peas and feed. In this strategy, we're really highlighting Canadian pea quality and sustainability advantages for processing, for ingredients, and for feed, and are building demand for the different ingredients that are derived from peas in end-use applications that are specific to those ingredients with volume potential. As I'm sure you're aware, today we're highly reliant on China as our major market for peas. And since we know that about half the peas going to China are being used in feed, we are also working to leverage that success and market peas for feed in surrounding countries in regions like Vietnam and Thailand. Here are some of the highlights of work that has been completed this year under the pea strategy. So there's 3 major projects that we've worked on. One is gathering annual data on Canadian pea quality for attributes that are relevant to processing and fractionation. We've just completed a project on pea starch performance in paper, pulp, and adhesion applications. And we've also set up 5 feeding trials in Southeast Asia that are going to test Canadian peas and feed for different species, including shrimp and swine. In terms of resources, we've developed 4 key pieces that are really relevant for our outreach work on peas. One is an environmental life cycle assessment for Canadian peas. And this work was extended to do an LCA on the use of Canadian peas in feed for pork and poultry and eggs in particular. And we compiled a feed guide for peas that's been translated into Chinese and Vietnamese for our outreach in Southeast Asia, and also created a pea starch technical guide for industrial manufacturers. Lastly, we've hosted 3 events this year to highlight pea ingredients. One is on protein, one was on fiber, and one was on starch. We're tracking all of the uptake and engagement we achieve through these initiatives so that we're measuring their success. For example, we had 139 downloads of all the pea resources to date on our website, and 94 of those were on the PLCA. So that's been the most popular. For our events, we had almost 300 attendees. The majority were for the Protein Summit. We had 184 attendees there. With the fiber event, we had 81 attendees. We've had a lot of success with the dairy and meat alternative audience in particular, who are interested in pea protein and are gaining a lot of new contacts, as well as we're directly interacting with stakeholders and having them access our data and our technical information. With the projects and resources that I just talked about that we've developed this year, specifically related to feed and to pea starch, we're expecting to have a lot more traction going forward on the feed and industrial applications audience. And although we can't link this directly to the work that we're doing, we are tracking progress against that longer term target, which is 1.1 million tons for peas. It's estimated by analysts that there's about 500,000 tons of Canadian pea processing and use domestically here in Canada for fractionation and milling and food and feed use. And also that about 100,000 tons of Canadian peas are going to the US. So that leaves us with about 500,000 tons of peas that need to be used in North America in order to meet this 1.1 million target. but we still have the opportunity to meet that demand as we continue to build demand for peas and pea ingredients and the applications that I talked about, and also continuing to demonstrate the Canadian pea quality advantages for those applications.
Julianne, you just have about a minute left.
Oh gosh, okay. So I'll just really quickly go through lentils here. So lentil strategy has a focus on ingredients, particularly flour, as well as food service. And some of the projects that we've done this year are a Canadian lentil LCA, a project on lentil flour performance in an application, a flour insights dashboard for stakeholders. We have a campaign on lentil flour targeting food manufacturers that we're planning to launch this spring. We've made some progress with particular audiences relevant to flour, but are expecting that to continue as we launch this flour campaign. The food service outreach work on whole lentils has been focused on the US. We're expanding that work into the EU starting this year, but this work's been led by Saskatchewan Pulse Growers staff. A lot of great results for the current year in terms of new content put out, event participation, tools for food service industry stakeholders. And we've actually surpassed a lot of our goals in terms of our outreach and our results with commercial food service operators in particular, and that would be like restaurant chains. What I might just do real quick here, just in the interest of time, is touch quickly on faba beans. So we have a North American focus for faba beans, building demand for ingredients and sustainable feed. Use of faba beans, some projects including a feed guide for faba beans and a life cycle assessment on Canadian production. A big event we have coming up in February. It's 2 parts, a virtual event targeting food manufacturers to highlight the opportunities with faba beans. We've had great interest in this event. It was just launched a couple days ago, the registration. I already have 140 registered. So I think that, you know, in general, you know, just back to the strategy framework, the strategy framework is important because it guides us. It guides the work that we're doing to make sure we're targeted and focused on the right opportunities to deliver volume. We're making some progress. Things are heading in the right direction, but there's a lot more work to do. These targets are longer term for us to achieve, but they do help to focus us. We have cross-cutting work that covers, you know, all the different crops and all the strategies. A lot of partnerships that we do with other groups and industry stakeholders are required for that work as well. We have a campaign on sustainability as another example of a cross-cutting initiative that's going on right now, and you can check out our Pulse Canada website on sustainability to see some of that enhanced content there. I think with that, I will just close off, and sorry for sort of flying through everything at the end there, but you know, hopefully that gives you somewhat of a better idea of some of the work that we're doing, ways that we're tracking and measuring progress, and happy to answer any questions when we open up that panel for questions.
Thanks, Julianne. Tough to cover such a large area of work in 10 minutes, but great job trying to summarize that for people. So our last presentation for this particular day is going to be delivered by Marlene Boersch, who's no stranger to providing market insight for pulse growers. She's been at it for quite a while. Marlene has a master's degree in agricultural economics and has traded and exported Canadian commodities, including pulses, for a number of years. And in 2003, Marlene co-founded Mercantile Consulting Venture, which is a private services company that specializes in private label market intelligence, risk management, and project consulting. And the company is very active in Canada and has grown to also include Australia and European Union. So Marlene, if you would like to present some market intelligence for our viewers.
Well, good morning, everyone. I'm delighted to be here, and I must say the presentation by Greg Northey and Julianne Curran are almost a perfect segue into this one, because you will see that the problems that Greg described do have a profound impact on the market, and the things that Julianne described give us some hope, because we are diversifying into other things and into domestic the side. We have some slides on that actually on the piece, which help us circumvent that a little bit while we are sorting this out. So here's a little bit of an outline, and I will skip the outside factors in ag markets because of time, because we have shortened the periods for the presentations quite a bit. But as Sarah Anderson in the initial presentation said, we don't have a crystal ball, and what we're trying to do with the market presentation is actually assemble the facts that we know, and also have a look at the facts as they're leading up to things that help us discern what's going to happen. And I personally think the outset factors are important when you look forward. So I'll skip through some of these slides. I have left them in the presentation, because if you want to look at them later on, you know, you might, because I'm leaving the presentation with the pulse course, so you might be able to do that. Let's see how to go forward. We seem to be stuck in the first slide, so bear with me for just a second. So as I said, I will skip through some of these. You know, we all know about the challenges last year. In terms of what's lying ahead is certainly more uncertainty, and why that is because the markets themselves are changing, as you can see here. And we are at a higher price level, which makes going higher actually a little more difficult. And overlaying that, and I'm not sure why it's jumping, overlaying that is global growth prospects that are actually not super exciting, which have to do with the ability to afford some of the higher priced commodities that we are growing. But this one slide, in terms of the initial overview, is the one that I wanted you to look at and keep in mind. And it shows the stocks to use ratio comprised by 12 crops. And it shows that in this outgoing year, in 2021, we are at the lowest level in 7 years. And that's something to keep in mind. It's not as low as we had in the early 2000s, but we have had a 7-year trend down. And what it means is, as we go into the next year, should we have production problems anywhere in the world, the price fluctuation will be fairly steep, because we have actually deteriorated some of the cushioning stocks, the ending stocks from the outgoing year, and it harbors you know, potential for fairly price volatile markets as we go forward. So with that, we'll actually look specifically at the pea markets, and here you have a summary of what happened last year, just production in metric tons. Purple is the pea production, and for the first time since 2011, we were actually below 3 million tons. And underlying that is the fact that 25 to 28% of the global pea trade, the material for that comes from Canada, so that has an effect on the overall market, obviously. And when we get to lentils, you will see that it's the first time we are below 2 million tons since 2012. And here we comprise 50 to 65% of global lentil trade. So our reductions, again, will have a profound effect on the markets and on the prices, as we have seen over the last year. So here's a review of the numbers for the 21 pea production. And I've circled the Mercantile numbers and the Stats Canada numbers on the right-hand side. The top green line is the yield, no surprise to anyone by now, which fell very, very significantly. So we ended up with 2.3 million tons of peas in Canada, and pea supply was down to about 2.8 million tons compared to 4.9 million tons the previous year. Prices actually reacted relatively slowly in my mind, certainly more slowly than lentil prices, and have been relatively flat since, except we saw about $1 bushel reduction over the last week or 10 days, both for yellow and for green peas. And part of that, underlying that, is some of the transportation problems. So we'll look at the demand side in a second. What about global supply? So when we reduce the North American and specifically the Canadian production radically because we are important in the trade, we also have to examine if there's anybody else that can substitute for that. And you can see here that we calculate that global production on the right-hand side this year versus last year was down about 15% by our calculation to 12.6 million tons from 14.9 million tons. And this reduction was almost entirely from Canada and the United States, where we lost 2.7 million tons from the previous crop, really. And we did have some increases both in the European Union and the Ukraine, which we calculate to about 200,000 tons, which obviously cannot make up for the North American losses. We did have a strong production in Russia. It was roughly the same production as the previous year, 2.7 million tons. So that has become certainly very, very important to a number of destinations. And I would point out that this time, for the first time that I've ever looked at, is the Russian production, rather, has been bigger than the Canadian production in 2021. And that's slightly frightening, actually, when we think about some of the destinations and the shipping possibilities from the Black Sea area to some of the destinations. However, I also wanted to, as we move more into the demand side, I wanted to show a trend that Julianne just has been talking about. And on the right-hand side here, you see 3 pie charts that depict the domestic components of the markets in 3 colors, in beige, blue, and the yellowish color, versus the export side in green, in dark green. And you can see that in 2010-11, the exports made up about 87% of demand. Below that, I'm showing 2021, 2021 and below 21-22, because it has changed from last year to this year to again. And you can see that the export side has actually shrunk from 87% of total use to 72% of total use, which is extremely helpful, particularly vis-a-vis the transportation problems that Greg described earlier. So the domestic demand components are increasing, and that includes the fractioning side, edible demand, and the feed, including the pet food side. And I should point out here, for somebody who studies these numbers, that the US pet food demand is included in my export numbers, actually. We estimate fractioning capacity at 600,000 tons. Obviously, we're not running at 100% capacity yet, so that kind of jives with Julianne's number of 500,000 tons as well. But I think the theoretical capacity has now reached 600,000 tons for the 2022 year. So for domestic demand, we can now look at 80 to 850,000 tons, including seed and all the various components, versus an export side that has been relatively stable depending on the demand for feed in China at 3.5 to 4 million tons. So total demand in a given year, 3.5 to 4.5 million tons, which is a fairly large market. So how have we done with exports year to date? And you can see on the right-hand side, pea exports by destination. The orange or brownish line, that's this year's exports versus last year, the dark green line. And it's quite obvious, you know, the important one here is China. You can see our demand for China has fallen precipitously. So year-to-date exports are 919,000 tons compared to 1.54 million last year, and that includes August to November exports. Stats Canada numbers, and we haven't reached yet by November, but November was very, very small at 96,000 tons. So we're down overall 40% from last year. And again, you know, as I pointed out, China is very crucial here because last year, China took 73% of all Canadian pea exports. That percentage has shrunk to 68% year to date and to only 19% in November. And that is because they stopped buying for feed because prices in the feed market were getting a little bit too high when you look at the transportation challenges, transportation costs versus some of the other products. Though I should point out that soybean and corn prices certainly have increased as well. It has also been difficult for our shippers, for our exporters, to accumulate tonnages suitable for bulk shipping, which is necessary to be able to work into the feed demand in China. So I would say for this year, we have lost that. And we'll look at our overall demand forecast for the year in a second. On the positive side, we can see that the exports into the United States are up 7-fold over last year's. And that is because the US also had a very small crop, as you know. And so we have been shipping into some of their fractioning demand, into the pet food side, certainly. Indeed, the United States has not only imported from Canada, they also imported about 20,000 tons from the Ukraine this year to really feed into their demand. So for our purposes in Canada, exports, I find it very important to distill out that exports to all other destinations, excluding China, are actually up by 3.5%, not down. That's partly due to the good exports into the US, into China, into Colombia, into the EU, Venezuela, and so on. So once we take that feed component that's more price sensitive out into China, I find it very, very interesting to see that we actually are. This just gives us an idea by the size of buying. These are stacked exports for 2015-16 to 21-22. You can see the red line is China. So we last year shipped in excess of 2.6 million tons to China. And when I calculate or project the total demand for 21-22, I have actually reduced China to only 1 million tons, assuming they will buy no more for feed, and that some of the feed that was shipped to them has actually been moved into the edible or fractioning market into China. The interesting part is that lowering China to 1 million tons got my overall export projections down to 2.2 million tons. The interesting part is that even with a relatively small or quite a small export volume, the projected ending stocks this year are 100 to 160,000 tons, depending if you use our numbers or Stats Canada's numbers, and that is a 4 to 5% stock use ratio, which is quite low. So in terms of what's left year to date, we calculate there's a little bit less than 1.4 million left on the prairies, including what we expect for ending stocks and so on. So when I look at these numbers, I would actually conclude that this should be supportive to current price levels, and yet we have seen that deterioration in demand, and I think that has a lot to do with the inability to source containers and access some of these smaller destinations, and also with the fact that for now it seems we have satisfied the demand into the United States, and if you follow that closely, you could see that they had been buying forward for some of the deferred month. So I think they are probably covered into the spring period for now, and that has led to the drop in price. So pea exports from Canada have been slow, albeit our supply was down very significantly. We are seeing that China is not topping up the earlier feed purchases, and there are also some difficulties with accumulating volume and securing freight to their destinations. But as I said, exports to other destinations combined are actually up from last year. So lowering demand to China radically still gets us to relatively small stock use ratios, so we are not going to be burdened with a high carryout into next year. And as I said, it's hard to rationalize why prices were falling, other than that the momentum is gone from the US buyers, and I don't see that recovering nearby. So with that, I wanted to look quickly at the 22 scenario, cost of production scenario on the right-hand side. And I also listed some of the assumptions we made in terms of yields and the prices I used for the cost calculations. And the reason I put that up is that a lot of people seem to be saying that pulse acres will increase fairly significantly in the 2022 period. And I don't see that. I understand the role of the cost of nitrogen and so on, But as you can see on the right-hand side, that red line I drew in there gives you returns per acre for canola at current prices, and they have actually gone up from the time since I made my calculation. And it seems to me that peas and lentils actually are not promising the same returns per acre as some of the other crops, including canola, which is very important, including durum wheat, which is very important to some of the barley lentil areas, including flaxseed and so on, and oats. So my prediction is a little bit different. I don't forecast a 6 or a 7% increase in acreage as Agriculture and Agri-Food did last Friday. I arrived at the conclusion that acres are more likely to be down by 3% because the forward price doesn't measure up the same way. And that would give us a production given about 35 bushel per acre, which is, we'll have to think about that a little bit as we go closer into the year, would give us 3.5 million tons and a supply of 3.6 million tons because carrion is quite low. Agriculture and Agri-Food is assuming 3.9 million tons for next year. I think exports should be back up to 2.6 million tons, partly because some of the importers are actually quite low in stocks, and some recovery of the Chinese market. Domestic use, as I said, is becoming more important, and we're assuming 800,000 tons for all domestic areas for next year, which would bring ending stocks for the coming year at 265,000 tons on 8% stock use ratio, which is up a little bit from this year, but it's certainly not burdensome yet either. We expect competition from the Black Sea area as well. I'm not sure there will be an increase in acres in that area because they also have very, very good wheat prices and some very good oilseed prices for the sunflowers there as well. Global balance sheet is tight still, and for that reason, I think that the new crop prices should actually yield us a little bit more than the $13 per bushel that we're seeing right now. So from our point of view, we would actually hold off in signing that acreage at that price level for now. And again, you know, I alluded some caution on yields, and that is the Agriculture and Agri-Food Drought Monitor as of December 31. There's also a very good soil moisture map as of freeze up in November by Les Henry that shows something similar, that things are not all recovered yet on the prairies. So that's just a little bit of a caution when we talk about acres. So with that, we do the same thing on lentils. You can see this supply side of the lentil numbers. Again, I boxed what's happening for this year, 21-22 on the right-hand side. Same thing, big reduction in yields, obviously, which took down our available supplies very significantly against the fact that we supply a large part of the export market, as I said earlier. So lentil supply 21-22 down to 2.1 million tons from 3.1 the previous year. And lentil prices did react over the summer and have been fairly stable actually since. And I actually forward to that slide, and it shows you what happened to lentil prices, green lentils on the left-hand side and red lentils on the right-hand side. Again, as in peas, they have been falling just recently a little bit, and that has, again, a lot to do with the ability to ship lentils. So in terms of global lentil supply, was there anybody who could make up for the losses we have been seeing in North America? And you can see that we estimate global production in this ongoing year was down a full 21% from the previous year to 5.3 million tons, down from 6.7 million tons. Biggest reductions again came from the Northern Plains in Canada and the United States, and that's down 1.4 million tons relative to the previous year. And I should add, production in Turkey was also down because of dryness in their production areas. We did see increases in Russia, India, and Morocco, but again, this cannot make up for the North American losses, henceforth the 21% shortfall. Russian lentil production actually is relatively small, and Kazakh lentil production has been falling over the last several years due to competition by flax and wheat in most of their areas. So they're not as dangerous to us as they are on the pea side. Moving on to the demand side, this is how we have done in terms of exports year to date. We have shipped 650,000 tons compared to 1 million last year to date, so that's down 37%. Again, November exports were really quite small, 80,000 tons. In terms of a dominant buyer last year, as you can see on the graph, India was extremely dominant and imported 36% rather of all Canadian lentils, and that has shrunk to 22% this year. So they have pulled back, and as you know, there was a lot of noise about some of their pricing issues there. However, on the positive side, year-to-date exports to the United States are up 1.5 times over last year's, and exports to Turkey and Algeria are also up 7% and 6% respectively. So exports, but however, different from the pea picture, exports to all other destinations, excluding India, are actually down. So we are seeing an overall reduction to almost most of our important end users. And looking forward, though, we do know that end user stocks are really quite low, but we are very dependent on the container side here, other than to India, perhaps Pakistan and Bangladesh, and that has been hurting this market very significantly. This gives you an idea of the relative importance of the various countries. And the two lines at the bottom, it's India at the bottom and followed by Turkey. Again, this is a stacked graph showing overall exports by destination. And you can see that almost all destinations, or basically all destinations, are down this year relative to last year in terms of volume taken. Biggest importer year to date has been Turkey, actually. So what does it mean to the ending stocks, the balance sheet? Because that is important when you're trying to make decisions about any lentils you're still holding from the 21-22 crop. And here I would encourage at this time of year, to get probably more heavily sold to 70-75% on the old crop. But based on an export projection of 1.7 million tons for this ongoing year, our ending stocks are going to be quite small at around 54,000 tons, which is a 3% stock use ratio. And we have about 850,000 tons left on the prairies. So this should be relative supportive to prices, but we need to be able to ship it. And the North American market itself, our shipments into the United States have slowed down because they have been doing some forward selling as well. However, when I look at recent news and what's happening in the market, I must say that lentil demand remains excellent into Bangladesh and some other destinations. I know there have been lots of inquiries by some of these destination buyers into Canada, but also into Australia. There's some decent price levels, actually, but the biggest problem is securing containers, and shippers both in Canada and Australia tell me, well, we will make a deal when I have secured the freight and have relative confidence that I will actually get it. So this is exactly what Greg Northey was talking about, and I think this problem is almost cumulative as we go through the year and makes it very, very difficult to have consistent relationships with our buyers. We have competition on the red lentil side by Australia because they had a very good crop this year, or the last 2 years, I should say. But I am told that Australian farmers are in no rush to sell a lot right now and have, to date, of their crop that came off in October, November, sold about 30–50% of their lentils. Again, as I said, they're looking at demand into Bangladesh and Pakistan, Sri Lanka, but have equal difficulty shipping there. When we think about next year's crop, Has there been weather damage on the Indian rabbi crops? There's some talk about that, and we'll have to follow that as we go forward. We also hear that Turkey is very, very dry, and there are definitely production issues they are developing already. Turkish lentils would be the next lentils coming onto the market from the new crop side starting in June. And it seems that their crop will be curtailed again this year. And then again, freight availability is certainly restricting the supply of lentils to buyers. So when I think about 22-23, I'm assuming that acres down about 1%, and I talked about the cost of production or the return per acre issue earlier, so I won't put that slide on again. I'm assuming a fairly decent yield, 1247. That's a 5-year average yield, including last year's low yield, I should add. Agriculture and agri-food is assuming about a 7% increase in acres, quote unquote, due to strong prices for the #1 grades. I assume they mean this year. Again, you know, we differ a little bit there. Our scenario would give us 2.4 million tons in production and 2.5 million tons in terms of supply. And we think, given some help on the transportation side, that exports should be able to move back to 2 million tons, domestic use around 350,000 tons, and that would bring ending stocks to 180,000, or an 8% stock use ratio. So these are the numbers and the assumptions that we make for next year's crop. As we see improvements in soil moisture or a more severe soil moisture, or problems with seeding, because there are some forecasts that May could be unusually cold actually this coming May, which would certainly hamper seeding of lentils, where we need some warmer soils. Then we'll have to adjust these numbers as we go along. But for now, it shows that things will remain relatively tight, albeit not quite as tight as this ongoing year. So we move quickly into the chickpea market. Here you can see on this slide harvested area of chickpeas from the year, I think it was 1995 forward into the 2021 year, and also production of chickpeas from 1980 actually to 2020. So it shows a higher volatility in terms of acreage and production. And I put these slides on because it makes it very difficult for processing to develop when you have such fluctuations in volume available, and also makes market development very, very difficult. Like for almost all crops, North American supplies this year certainly are down, both from the Canadian and the US side, and we will look at the combined production in a second. So on the Canadian side, 21-22 acres were down. Obviously, we had low yields here as well, and we're assuming a production of about 71,000 tons, which is really quite small, but we had a fairly sizable carry-in from the previous year, so that supplies were around 280,000 tons for this ongoing year. Our export projection is only to 100,000 tons compared to 163 the previous year. Agriculture and agri-food is using a much higher number, but I'm a bit skeptical on that. We have had some pretty good demand on the domestic side, including pet food, and so our ending stocks reflect about 85,000 tons, which is a big reduction from the previous year. And this is one of the reasons. This shows you some of the Canadian and US large chickpea production split out from 2010 to 2021 for various years. And it shows that we're basically down to 2010 levels when we've had much, much higher years in the past. So supply is down certainly pretty radically from the preceding years. In terms of demand, year-to-date exports have actually been fairly good. In fact, they're about 6,000 tons higher than last year. And that's based on exports to the United States. You can see that on the left-hand side, where we've shipped 14,000 tons year to date, United Arab Emirates, Turkey, and Italy. All other destinations are down. These are some of the better paying destinations, certainly the United States, UAE, and Italy. So exports to Turkey are up an impressive 5-fold, which reflects on their own production over the last year. Italy has been very good, it's almost up 4 times. But shipments to Pakistan are down by 40%. And there we have seen competition by Desi chickpeas and also the smaller kabulis that some of the smaller kabulis that are grown in Australia. So the higher priced markets seem more or less full. And that's certainly most notable for the US market and to Italy. And they seem to have covered into the spring months for now. And like on lentils and peas, we have seen a reduction in prices there as well. And I should overlay there that we have also seen some very big price fluctuation in the major markets, which we have followed a little bit. Major markets, I mean, canola, canola, wheat. But they have been recovering because of the threat of unrest between Russia and Ukraine. And I haven't mentioned that so far yet, but that certainly could impact shipping from the Black Sea area in the coming year. So we'll have to keep a keen eye on that as well, particularly with respect to peas. So we have had well-priced shipment into the United States earlier this year, around the 45 to 55 per hundredweight dollar level. But as of January, since Christmas, the demand has certainly slowed, and we are told that the demand seems to be covered into the late spring, early summer. So we would recommend, if you see bids still in excess of $45, we would sell some of the old crop or all of the old crop. Other markets seem to be priced lower. And we also hamstrung by very expensive container prices. And we seem to be facing some competition here from Australia and also from some of the Indian kabulis. I'm not sure about the chance for price recovery without new or additional demand from the United States. And we will also be facing the next new product on the market in the early summer from India and Mexico. Planting of all chickpeas is up 8% right now in India. And in Mexico, the numbers we have seen as of late November showed seeded acreage up about 10% and a strong start to their season. And that should give them export potential of about 150,000 tons, which would compete with some of our kabulis as well. In terms of 2022, well, we haven't seen a lot of contracting yet, but given the $35 level that some people seem to be thinking about, we again think that lacks the return potential relative to some of the other crops. However, given the dry conditions and so on, agriculture and agri-food seems to think a 13% increase in acreage, and here we haven't argued. So even if we assume that increase, we would have a production of 127,000 tons and supply back to 237,000 tons. We do think that exports should be able to recover to 120,000 tons. And that would actually, given a good domestic demand again on the pet food side, would leave ending stocks somewhat reduced. Again, you know, we will have to follow the yields this year and yield potential as we learn more about the conditions. And so you can see really in terms of supply, we have seen deterioration of supply over the last several years, and also finally a drawdown of ending stocks on the chickpea side, which would be very healthy for the market. So I hope I haven't overstepped my time too much, Corey, but I certainly, you know, will be here to answer some questions.
Great, thank you, Marlene. No, I think we're good for time, right? Actually, we're almost perfect. So I'm just going to turn it over to Amber, though, to manage the question and answer period for the next 15 minutes. So any questions for any of the last 3 panelists? So Amber, if you want to take over.
Thanks, Corey. I'll just ask, we've got Laurie back, and if Julianne and Greg could
join us back here with your cameras. Got a few questions that we've kind of prepared, and definitely encourage any one in the audience to place any questions for Laurie, Greg, Julianne, and Marlene into the question box at any point here, and we'll try to address these here in the next few minutes before we wrap up. So I'll start with maybe Marlene, since we're just going hard here, we'll curtail on a few questions for you and then move to the others. So question, Marlene, for you regarding kind of linking back to Greg's talk on the container issue. Is there any way that you can envision quantifying, how much of an issue the container problem is for pulse growers and what the financial impact has been over this last year, moving that issue into the supply and demand story?
Well, it's very hard to quantify the volumes lost. I know that we have lost, we arrive at the markets with the higher end of prices very consistently because of that. This year we were lucky because competition was actually less. So, to quantify that is fairly tricky. But in terms of impact on the growers, if we say that, and maybe Greg can help with some examples on the container rates, the increase in container freight actually converted to a per ton level, and I would guess a lot of it would be $30, $40 a ton, will actually reduce your bottom line accordingly, because when you do an export offer, you will have what's called a work back calculation. So you subtract all the various costs that you will have to arrive at a viable grower bid for the farmers. And as that freight component is very, very high, it will reduce the returns to the farmer accordingly. So the impact is severe, and it matters to every single farmer in both the inability to ship, but also for every ton sold, you're actually paying for that oligopolistic behavior, to put it fairly bluntly.
Thanks, Marlene. I appreciate that answer. One more for you before we move on here. Do you have a sense at all of how many producers are concerned with dryness going into the 2022 growing season? You mentioned, looking at a 5-year average potentially for next year, and if yields this year are significantly down due to concerns over dryness, will that 5-year average have a major impact on your price outlook for peas and lentils for next year, if that's the case?
Absolutely. The one reason I put that slide with aggregate carryout on is exactly that. What I said then is that when stocks are low and you have a threat to your production in terms of dryness, and when I showed the map, I think, for example, here in Manitoba, we've had a lot of snow. Now we have to hope it actually goes into the soil and so on. But that impact, any threat to the production will cause a more volatile reaction to price when you have few stocks, because there's no cushion. So are farmers concerned? Yes, most farmers, not everybody, but particularly in the Palliser Triangle and in the bright red areas shown on the drought map that AFC did as of December 31. Most farmers are concerned that without good spring moisture, they're looking at substandard yields. Now, I should add that in the 5-year average yields that I used, I included last year's low yields. So, there's that bias to some degree is included in there. It's not the 5-year prior, but it includes the very low yields last year. As we go forward, we'll have to adjust those either up or down. We can go either way, and adjust our expectations as we go forward.
Great, thanks, Marlene. One more question for you here, and then we'll move on. How much of the yellow peep crop can our industry realistically consume within North America, do you think?
Well, I had that number for Canada, including seed demand and so on. I think it was between 800 and 850,000. We probably do another 150,000 for the pet food side into the United States and some of the fractioning there. So we are getting, say, to 900 950,000. So it's becoming very, very important. And what it will do, it will stabilize actually demand to some degree, because it will fluctuate less than the demand overseas, because it's harder to compete with us into those markets. So to Julianne's point, the more domestic or North American demand we can create, particularly on the manufacturing side, that will give us some stabilizing effect. Having said that, we should continue to diversify all export markets, et cetera, as well. Vietnam was mentioned and so on. So that's very, very important, because we want to continue shipping. And the more markets you have, the safer, in quotation marks, you are.
Absolutely, and great transition. We'll maybe move to you, Julianne, for a couple questions here. Thoughts, Julianne, from your end, if there was one area where maybe in our market development efforts we need to do more work, or there's more effort that needs to be put into a specific area of the strategy, is there one that stands out in your mind versus ones that are kind of chugging along kind of nicely on their own?
Yeah, absolutely. I didn't have a lot of time to get into this, but you saw, the work that we're doing, the progress we're making on the pea side, and see that from Marlene's data as well. There's a lot of momentum there with the fractionation capacity for peas and the demand for protein. Consumers, I mean, it's not just about ingredients. There's opportunities for whole pulse consumption as well, as consumers are looking at plant-based foods. And for whole pulses, there's a lot more familiarity with chickpeas and beans. Those are the ones that consumers kind of go to. But when we think of all of the crops that we're producing here, faba bean is emerging and growing, and is becoming very quickly an alternative to peas, both in terms of production and fractionation, processing, and utilization. But lentil, if you think of across the board, there's a lot less, like very limited value-added processing happening here in terms of ingredients, and there's a very low consumer familiarity compared to the other pulses. So that really is the crop that, if we want to see more consumption and utilization here domestically and in North America, that's meaningful volumes, we have to put a lot of effort there, also given our high production levels here, as compared to a smaller crop like faba bean and chickpea.
Great. And one more question maybe on faba bean here. Just wondering what your thoughts are regarding inclusion of that new faba bean varieties coming down the road, and how they fit into the market, specifically related to low visine, con visine. Would you say that market is open, developing, in its infancy, or a long way to go? What are your thoughts kind of on that area of the strategy?
Well, we've just really started to have a dedicated market diversification focus on faba beans just in the last year, as the production here in Canada is growing. And what's really, I think, profound for us is like the amount of interest there is already with the processors in the food industry. And like, just sort of as an anecdotal piece of evidence, I think I mentioned in my presentation, we just launched this event, and we have almost in 2 days more attendees coming to an event on faba beans than we had on one on protein. So there's some great interest there already to begin with. In terms of the varieties, I think that that is going to be one sort of like unique advantage that we have here in Canada, to have those varieties. And I think that it will also help us to get faba beans into not only the food markets, but also into pet food. That's been one of the challenging markets to get the ingredients into. And I think that these varieties are going to open those doors for us.
Great, thanks, Julianne. I'm going to try and sneak one question for Greg and one for Laurie, and before we reach time here, so we'll see if we could do it. Greg, for you, can you share a bit more of what Pulse Canada is maybe actively doing on this container issue? What more could be done to bring both attention and action on the issue specifically?
Yeah, thanks, Amber. So it was pretty clear from the beginning of this that there needs to be more attention, or at least government needed to have more attention brought to it. So we've launched a campaign. It's called containercrunch.ca, and Folks can go to the website there and have the ability to send in a letter to various ministers and MPs just raising this concern around the containerized supply chain. And so that's a partnership. Something we learned very early on was that it's not just grain that has this issue, it's across the spectrum of groups. So we've got the fresh produce side, we've got forestry, mining, etc., all looking at this. And so we have some key asks there. So that's really our sort of front-facing media approach. We put out some media releases, and we've gotten some good traction on that. There's been questions raised in question period at Parliament and that kind of thing on it. The second piece is really working with the same group to do an impact assessment, to understand what it's costing us as a sector and the Canadian economy, why it's happening. And that's really pointed towards those long-term issues where can we do the things we need to do now with that whole system, with the shipping lines, both how we regulate them and legislate them, to set us up for the future, because it really is now at this point, the fall, the next grain year, the one after that, we're just not sure it's going to be ready or it's going to be there for us to use it. And to Marlene's point, it costs us, when the shipping line makes $3 billion of profit in 1 year, they're extracting that from somebody, and generally they're extracting it from the economies of countries like Canada. So that's our sort of short-term and long-term priorities.
Great, thanks for sharing that, Greg. Laurie, I'm gonna throw one question your way here before we wrap up today from this great little Q&A session. So this question is regarding variety suitability across different environments. So aside from just the north and south growing regions, which you mentioned in your presentation, are there any indications of pulse varieties being better adapted to different growing regions in any of the work that you've been doing so far?
I think what we're seeing is there's a huge factor involved with the actual weather conditions. It's been really hard to sort of pinpoint that a particular variety does better in, let's say the Assiniboia region versus Redvers region, that sort of thing. I think the actual environmental conditions is going to play a large factor in figuring that out. And that's something that we're going to be looking at. We're going to be looking at using weather station data and some collaborations where we can start to incorporate things like temperature and rainfall and all of these things to see whether a variety is going to do better. Like, how competitive is it under ideal conditions versus challenging conditions? And that's where you're really going to start to see some differences.
Absolutely. That's great. Exciting sneak peek into what's to come in the future here. Thank you, all of our presenters from this last half of the morning here. I'm going to pass things back over to Corey to leave us with some closing remarks.
Sure. Well, thanks, Amber. And yeah, again, thanks to all the presenters today. I think we had a really broad range and packed a lot into this last 3 hours. So really appreciate the effort that each of you have put into delivering these great presentations. And thanks to everybody that joined on the online. And as I mentioned at the start, this is sort of a fill-in for the situation that we're in currently, and hopefully we'll get back to the sort of the more traditional in-person type meetings rather soon. So once again, just to reiterate, thanking our sponsors for today, Boersch, Nexus Bioag, and Syngenta. Thanks for supporting this virtual session and sticking with us, and again, your support for pulse growers in Saskatchewan. Everyone that joined today is going to get an email about this event, and if you could just take a couple minutes to provide an evaluation and just if you've got some tips on how it could be improved, we're always like to see that and just improve wherever we can on these kinds of programs for growers and for agronomists. And if you haven't already, the next session is February 2nd, which is sort of the second half of what we did today. And so you could join in on that one as well if you haven't already signed up. The information is all on saskpulse.com to register for that session. So with that, we'll close off for today. Thanks for joining, and have a great afternoon, everyone.